Financial Modeling, Topic 10, Bond Valuation, YTM, Duration, Convexity, and Bond VaR, Copyright Lou Gaddis. In this topic, we're going to value bonds using the present value of promised cash flows or contractual cash flows, and also compute YTM, or yield to maturity of the bond, given the bond's price. We'll compute the sensitivity of bond prices with respect to changes in the discount rate using duration and convexity, and calculate the VaR of a portfolio using duration and convexity VaR. Lastly, we'll understand the duration and convexity of mortgages and use Excel's built-in bond functions. The fundamental value of a bond is the present value of expected cash flows. So you can say that the value of the bond is the sum from I equal 1 times T times F. And when this topic, we're going to say T is the maturity of the bond in years. F is the frequency of payments. So if you have a bond that makes semi-annual payments, your frequency would be 2. So we're going to sum from I equal 1 to the total number of payments of the bond. If it were, say, a 5-year bond with payments twice a year, that would be 10 payments. Of each cash flow, the cash flow will either be a coupon payment or a par payment, which is paid at the end of the bond's life. Now we're going to discount it at a discount rate R. In this case, if we're using, say, semi-annual payments, we'll divide R by 2 and discount the 6-month cash flows at the 6-month discount rate. And this R can also be considered our discount, or our yield to maturity of the bond, or required yield on the bond. So I'll grab this data here. There's 2 bonds, 2 5-year bonds. And those 5-year bonds have a coupon rate of 10%. The discount rate, we're going to discount the cash flows, is 9%. Has a par of 1,000, matures in 5 years, and the first one has a frequency of 1, and the second one has a frequency of 2. So this is an annual payment bond, and this is a semi-annual payment bond. The annual payment bond has 5 cash flows, periods 1, 2, 3, 4, 5. And those cash flows will simply be the coupon rate, I'll anchor that, times the par, and I'll anchor that. So this bond is going to pay $100 every year in coupon interest and pay back the par at maturity. So those are my cash flows. How much would you pay for it? Well, if you demanded a 9% return on your bond investment, you would discount these cash flows at that rate. So I'll discount the first cash flow and so on. So there's the present value of my cash flows. If I sum those up, it says I would pay $1,038.90 for this bond. So that would be the intrinsic value of the bond, or the discounted cash flow. If this were a semi-annual payment bond, there would be 10 payments. And each payment would be the annual coupon rate divided by the frequency, say twice per year, so you get half the coupon twice a year, times the par. So you'll just get $50 every 6 months, so these are now 6-month periods. And at the end, you also get the par. And I can discount these cash flows at 1 plus the discount rate, annualized discount rate, divided by the frequency to get a 6-month discount rate, raised to the period. So I can take the present value of those and sum them up. So this bond, I would pay $1,039. And for the annual payment bond, I would pay $1,038.90. So that's how you value bonds. You determine a discount rate. Now this discount rate should reflect, say, the riskiness of this bond, the probability that this bond would, say, default. Given that your assessment of the risk of this bond, you determine you want a 9% return. If you were to pay $1,038.90 for this bond, you will earn 9%. Now we're going to use a bond function to calculate the value of the bond, just to show you a different way of calculating it. Here's a function called bond val, takes in coupon rate, par, maturity in year, frequency, and discount rate R. It determines the number of payments, which will be the years times the frequency, and then does a simple for loop for I equal 1 to the number of payments, and what it's going to calculate is the coupon rate times par divided by frequency. That would be the periodic coupon payment divided by 1 plus the periodic discount rate. So this section here, this loop, is going to calculate the present value of all coupon payments. And since it has bond val equals bond val plus, it's going to add up the present value of all coupon payments and sum them up. Then the last step is then take the present value of the par. So it's going to take the bond val that currently has the present value of all coupon payments and add the present value of VaR. So we can take this function, copy it, and I'll go to Excel, go to my Developer tab, Alt F11, or Developer Visual Basic. I'm going to insert a module. I'm going to paste that, and I can show you that we could, say, insert the value of the bond, say, right here. I'll go to user find, bond val, so I need coupon, par, maturity, frequency, and discount rate. And you can see we have the same value as taking the present value of cash flows before. So now we can use this function bond val. And I could use it over here, calculate the value of this bond, and what you see is you get 1,039.56. So that's bond val. All right, so let's talk a little more about the discount rate. In this case, I'm considering R a discount rate. It's a rate in which I would like to earn on this bond, or a required return I want on this bond, given its risk. But another thing we can do with that interest rate is calculate something called a yield to maturity. The yield to maturity is you would look at the market price of the bond and determine what yield you would earn if you bought the bond at its market price. So it's a slightly different type of exercise, right? In this exercise, we said we want a 9% return. To get a 9% return, we want to pay 1,038. However, we can look at the market price. Say the market price is 1,045. We can then back into, well, what is the discount rate that we expect to earn on the life of the bond given its current market price? So let's assume the first bond is selling for 1,045 and the second bond is selling for 1,047. We could calculate that the cash flows, we'll just use these cash flows here. Let me just copy these for this first bond, and I'll just paste them down here as values. And if I paid 1,045 for this bond, these would be my cash flow investments. I pay 1,045 today, receive 100, 100, 100, 100, and 1,100. I can then just take an IRR of that series. And we would call that our IRR of the bond investment, but in the bond world we'll call it the yield to maturity. It's the yield you would expect to earn given the current market price. So it literally is the IRR of the investment of the bond, assuming the bond makes all the contractual payments. So another interpretation of this yield to maturity is sometimes it's called the promised yield. In some sense, it's the best case scenario in that if you buy the bond at the market and it does not default and you get all the contractual payments, all the promised payments, that is the yield you earn. I think we could do the same with this bond. I just paste in the cash flows here and say we paid 1,047 for the bond. I can calculate the IRR of this bond investment. Now that's going to be a 6-month return since these are 6-month periods. So I really should multiply this times the frequency. And see, this bond will give me an 8.817% return if I pay 1,047 and I receive all these cash flows. It also assumes you can reinvest those cash flows at that yield. All right, so that's the yield to maturity of the bond investment. It is the rate of return you'll earn if you pay the market price. Let's talk about interest rate risk with a bond, interest rate risk. Let's look at this bond here. Say you require a 9% return on this bond. Given that, we would pay $1,039 for the bond today. But what if, for some reason, rates were to go up? Say the riskiness of the bond goes up, or just the overall level of interest rates goes up from, say, 9% to 10%. Well, if the interest rate goes up, these cash flows are now get discounted at a higher rate, and the bond's going to go from $1,039 to $1,000. Discount rate goes to 11. It's going to go to 900, 12, 900, or 926. So what you see is as the discount rate goes up, or as overall interest rates go up, either due to inflation or the risk of this particular bond or overall level of interest rates, the value of the bond will go up. So what we say, there's an inverse relationship between a bond's yield, discount rate, and price. And if the yield were to go down, the price will go up. So that's the basic relationship between yields and prices. There's an inverse relationship between yields and prices. If we'd like to get a measure of the riskiness of a bond, we can see how much the bond values change as the yield changes. And how we're going to measure that is something called duration. Specifically, we're going to calculate something called Macaulay and modified duration. There's another duration that's often used, effective duration. We'll discuss in a later topic. So what we'll notice here is for this bond, again, there's an inverse relationship between price and yield. And we would notice that if this bond here, what if we made this a 30-year bond? Let's both give them a starting discount rate of 10%. So say both of these bonds, a 30-year bond and a 5-year bond, are both selling for $1,000. And yields go up. I'm sorry, we'll have them go down to 9%. This bond just picked up $100 in value. This bond, change in value, is $39. What you see is bonds that have a longer maturity are more sensitive to interest rates. Again, this is using the bond function, so I don't have to worry about adding all the 30 cash flows here. So, and that would make sense. The longer the maturity of the bond, the more sensitive it is to changes in the discount rate, since for, say, a 30-year bond, you're discounting some cash flows over 1 plus r to the 30th power and 29th power. So you think it would be much more sensitive to changes in the discount rate. So a simple measure of riskiness of a bond is how long-term the cash flows are. And that measure we're going to calculate is something called Macaulay duration. It's sort of a measure of when you get your cash flows for a bond. So the way to think about Macaulay duration, it's a kind of an average maturity of the stream of payments associated with a bond. Now, you'd normally think to say a 5-year bond would just have a 5-year duration, but that's not true, because a 5-year coupon payment bond you get some cash flows in year 1 and 2 and 3 and 4 from the coupons, and then the final par. So what Macaulay duration does, you can think of it as calculating an average time to getting all your money back, where it's going to weight all those coupon payments too. And the formula is it's going to sum up the present value of each cash flow divided by the total value of all the cash flows. So it's the fraction of the first cash flow, say, in the first period, times 1, plus the fraction of the second cash flow times 2, plus the fraction of, and so on. Now I can pull this 1 over V out, the value of the cash flow, since it doesn't vary with I, and say that the Macaulay duration is 1 over the value of the bond divided by the weighted average time to getting your money, where you weight it by this factor. So let's go ahead and do that in Excel. I'm going to create a column here called I times the present value of I divided by the value of the bond. So in period 1, in present value terms, we receive 47% of the value. We divide that by the total value of the bond. So we get 4.6% of the cash flows in present value terms, and you just multiply times 1. And then we can copy this formula down. And if we sum it up, we can get the weighted average time. So on average, you get your money on average in period on a weighted average basis, 8.14 periods. Now this is not the Macaulay duration, since these are 6-month periods. To get to the Macaulay duration, I then need to then take my weighted average period and divide by the frequency. So I'd say this bond has a 4.07 year Macaulay duration. In other words, I get a little bit of money in year 1, 2, 3, 4, and then a big part of the money in year 5. On average, we get our money back in 4.07 years. And we're going to calculate one other measure, and that measure is something called modified duration. Now, modified duration is going to be very similar to Macaulay duration, except it's going to reduce it by the discount rate. So it's, in some sense, it's like the present value of Macaulay duration. But specifically, this modified duration is going to be equal to that weighted average period divided by 1 plus the yield to maturity divided by the frequency, and then divide all of that by the frequency. So in some sense it's just the present value or the discounted value of the Macaulay duration, and we call that the modified duration. So modified duration, it's going to be that weighted average time to getting your money back divided by 1 plus the periodic discount rate divided by the frequency. And we have a function here to do that calculation. We'll call it mod dir. I'll copy this. This function requires that you also have bond val in your same module, because the first thing it does, it values the bond and then uses that to calculate the fraction of each payment. So I'll take that function. I'll go to my VBA. I'll paste in bond or mod duration. And then I can show that I get the same value using the Excel function, or the user-defined function we just created, mod dir. We have the coupon, par, t, frequency, and r. And there's my modified duration. And you can see in the function it does a loop where it calculates the fraction of each cash flow's present value and weights it by the period I. Now the reason why I want to get to the second measure of duration, it just so happens that modified duration, which for say an annual payment bond is just the Macaulay duration over 1 plus the yield to maturity, is equal to the negative of the slope of the price yield function divided by the price. So if I think that bonds have an inverse relationship, or the bonds have an inverse relationship between bond value and yield, we'd say that the function may look like this, right? Inverse relationship, negatively sloped. And to say if this is the current bond value and if this is current yield, what the modified duration tells you is the slope of that price-yield relationship at the current price. Another interpretation of modified duration is you can think of it as the first derivative of price with respect to yield, and then divide it by price to make it a percentage. A third interpretation of modified duration is the number, say 3.89. That number, 3.89, tells you the percent change, estimated percent change for a 100 basis point change in rate, assuming an inverse relationship. So if we're looking for a change in value of a bond for a given change in yield, delta y, we take minus the duration, since it's an inverse relationship, times the change in yield, times the initial value of the bond. So let's do a little exercise using that concept. I'm going to grab this data here in yellow. And I'll put it in a new worksheet. Same workbook, so I'm going to use those functions, bond val and duration. So what if I have a 10% coupon, 9% discount rate, 1,000 par, 30-year semi-annual payment bond that's selling for $11.03, which happens to be the present value of the cash flows. In other words, this is the bond's yield to maturity. In this case, the discount rate is equal to the yield to maturity. So you can see bond val also gives you 1103, and it has a modified duration of 10.187 years. So notice this duration of this bond is a little bit longer. The longer the maturity of the bond, the higher the duration. And then we know that the bond currently has a 9% yield. Let's see what if the 9% discount rate were to go to 8 to 7 to 6, so another down 100, 200, and 300 basis points, or up 100, 200, 300 basis points. Let's see what happens to the change in the value of the bond using our new measure of price sensitivity, duration. We'll call this the duration estimated change. So we'll go ahead and calculate that. We'll take our formula minus duration, anchor it, times change in yield. So if the yield were 600 or 6%, that would be down 300 basis points. I won't anchor that. Times the initial bond value. I expect to gain $337, or lose $337 if rates are plus or minus 300 basis points. And we can see why this makes sense. This modified duration, 10, it tells you that if rates are plus or minus 100 basis points, you'll lose or gain 10%. So for 300 basis points, we expect to lose or gain 30%, or about $300. And if we want the new duration price, since that's just the change, I would take my change in value plus my initial value, anchor that, and say the bond would go from 1,400 down to 760 if rates are down plus or minus 300 basis points. So these are estimates of change in value of the bond. A way of thinking about that is if I were to think of duration as a slope of this price-yield relationship. What it is, it's a linear estimate of value change. So it would be plotted along a straight line. So it's a linear estimate of value change. And if I were to graph this, you can see it's a linear estimate. I'll just insert a graph right here. So you can see my bond sensitivity. It's a negative relationship, inverse relationship. And the estimated value change is assumed to be linear, and that's what duration will tell you, plus or minus 300 basis points. Now I'll go ahead and add the x-axis to this. So this gives me value of the bond, plus or minus 300 basis point change in yield. Now I'm going to do something here. I'm going to actually value the bond. All right, so why estimate the value of the bond? Let's see what the actual price-yield relationship looks like. So I can insert my bond val function. Insert my bond val function. I'll go ahead and put in the coupon rate, anchor it, the par, anchor it, the maturity, anchor it, the frequency, anchor it. But where it says discount rate, I'll let it vary to 6, 7, 8, and so on, so I won't anchor that. So here's the actual estimated value of the bond, given plus or minus 300 basis points. Now I can add that to my graph. And you see, this is the actual price-yield relationship of the bond. You can see it's nonlinear. it's curved, and we expect the function to be curved since the value of bond, you're taking cash flows to the first, second, third, fourth, fifth, up to 30th power for this 30-year bond. So you'd expect the relationship to be nonlinear. The way we describe this function is we say it's convex. In other words, it bows out away from the axis origins here. So this would be a convex function. Mathematically, you can either have convex functions or say a concave function if it were shaped bowed towards the origin. So we can do one more thing with this. Given that we know that duration is a linear estimate of value change, you can also notice that it does a pretty good job of just predicting small changes in yield and price, but it doesn't do such a great job when there's a big change in the yield. So what we can do is we can get a measure of the curvature of this price-yield relationship. Use that measure of curvature, which we're going to call convexity, to make an adjustment to our duration estimate of value change. So far what we've done is we've determined the slope of a bond's price-yield relationship, the duration. We've estimated duration value change for plus or minus 300 basis points, and we found that's linear. So duration provides a linear estimate of value change. We've looked at the real price-real relationship using bond val, and we saw that it's nonlinear, and specifically we found that it's convex. So let's get a measure of this convexity. All right, notice we like convex bonds. I'd rather have bonds that have value functions look like this, that it's always worth more than say a zero convexity bond lying along this line. And what we find is the more convex it is, the more duration mismeasures the value and underestimates the value of the bond. We can use that convexity and add it to our duration estimate of value change, minus duration times change in yield. Take that convexity measure times change in yield squared times 1/2 and get a total value change that adjusts for both the linear estimate and the nonlinear or convex function. All right, so let's go ahead and calculate that convexity. Convexity is equal to this formula. All right, we're not going to prove that, but we're going to go ahead and put that into VBA. Another interpretation of convexity is it's the second derivative of price with respect to yield. So it's telling you how the slope changes, or how duration changes. So I'll go back to VBA, put in my convexity function, and I'll calculate the convexity of this bond. Coupon, par, maturity, frequency, discount rate. And you see this bond has positive convexity, means it bows outward. And it's positive, that means again that's positively convex. And the larger the number would mean it'd be more bowed. And this is how we use convexity to get what we call a convexity adjustment. And what it is, it's an adjustment to the duration value change, this over here, to adjust for the nonlinearity. So we'll take 1/2 times the change in yield squared times convexity, anchor that, times the initial bond price. And we call this the convexity adjustment. Notice it's always positive, since the change in yield squared is always positive and convexity is positive. It's given us these distances here. It's given us linear estimates of these distances, these errors. So if I take my duration price estimate plus convexity adjustment, so I add this to my duration, I now get numbers that are really close to the actual bond value. So let me add that to my graph. And you can see it lines up pretty well. Now, it's not exact. There is a little bit of error left over, and that's probably because the third derivative of price with respect to yield is not zero. but we usually stop in finance and just calculate the effects of the first and second order derivatives, and that is convexity. So we'll go back to this picture here for a minute. So what we did is we estimated the change in value due to duration using the slope, estimated the convexity of a bond, then we calculated these distances, these differences between the actual bond value and the duration estimate, and this little distance here would be the convexity adjustment. Let's just talk a minute about mortgages. Now mortgages, say a 30-year fixed rate mortgage, you can think of it as a 30-year bond in which the owner of the bond has the ability to prepay at any time. Now a normal, say 30-year bond, or say I guess 5-year bond, whatever it is, a non-callable bond, would have positive convexity. For a mortgage, if we were to graph the price-yield relationship, we also have an inverse relationship between price and yield. And a 30-year bond has about the same duration as a 5-year non-callable bond. Now the reason that is even though it's a 30-year instrument, it's not going to have the duration of a 30-year treasury, which we said was about 10 years given this yield and this discount rate. All right, so the reason why is because mortgages can be prepaid at any time, and people tend to hold on for mortgages for a few years and then either prepay or get cash out refi or move or whatever reason that people decide they want to prepay their mortgages, either due to interest rates or changes in life or location. So mortgages on average have about the duration of, say, a 5-year bond, except a mortgage convexity is not positive, it's negative. Now you normally would call that concavity, but in finance we actually call that negative convexity. And let's talk about why that would be for a minute. Again, a mortgage generally can be prepaid without penalty by the homeowner at any point in time. So let's say a bank has a mortgage and it's worth, say $100,000 at a 4% interest rate when it's issued, so it's maybe priced at par. And as interest rates go up or down, the present value of cash flows inversely related. So you would think they're convex, but it's not, because what happens as interest rates, say, go down 100 basis points, you would think the value of the bond, the value of the bond is going to go up, but it's going to be limited, because even though the present value of cash flows would go up with a lower discount rate, it is more likely that the bond is going to be prepaid by the homeowner and sent back at par. So we say that mortgages have what we call pull to par, or it's very hard for a mortgage to be priced much above par, because at any point in time an investor can prepay and deliver the par amount back to the bank. So you can think of this as the value of par. If rates go down, you can see this 5-year note starts going up and up and up, but the mortgage starts getting limited, that you're not going to pay much more than par for that bond, that mortgage bond, because it can be prepaid at any minute. Now another interpretation of this negative convexity of mortgages is another interpretation of duration. Duration is the slope of the price-yield relationship. Say a 5-year bond and 30-year mortgage have a similar duration, except if duration is a measure of kind of the average life of the bond, as the interest rates fall, the duration, which initially was, say, 4 years, might fall to, say, 1 year. So what you can think about it is it's a flattening of a curve. If the slope of this was -4, now it's -1. So if you consider duration as the first derivative of price with respect to yield, as rates fall in a mortgage, the duration is going to fall as the instrument is expected to prepay any time, and the duration might fall to, say, 2 months or 3 months or 0.2 years. On the other hand, if interest rates start to go up, the mortgage is going to devalue quicker than the callable bond. And one way of thinking about it, the non-callable bond, one way of thinking about it is, again, the slope. If we thought a mortgage might be out there 3 to 4 years, if rates go up and now that mortgage is very valuable for the homeowner, they'll be less likely to do, say, a cash out refi, or just prepay the mortgage. Maybe they might delay even moving if they have such a great mortgage rate. So you might say that mortgage, which you thought might last 3 years on average, now might last more than 5 years. So another way of thinking about that is the slope has increased, the duration. So much has been written about the negative convexity of mortgages. They make them generally a very unattractive instrument for banks, very attractive for a homeowner because you get to prepay anytime rates go up, and then if rates go down, if rates go up, you kind of extend and hold on to it longer and longer. Well, that really hurts the banks, all right, because banks do not see the upside as much because it's going to not be valued much more than par. And as rates rise, and the time when the bank may want to have its money back to reinvest it in higher yield mortgages or other types of fixed income securities, the homeowner at that point chooses to hold on to the loan longer. So next thing we're going to do is talk about how to measure the risk of a bond using duration and convexity. I'm going to calculate something called a duration and convexity VaR. All right, so we said that the change in the value of a bond is equal to the initial bond value times minus duration times change in yield. That's the linear duration estimate, plus 1/2 convexity times change in yield squared, and that's the nonlinearity part. So we can calculate a X% confidence interval T-day VaR for a bond by substituting in this delta Y, the change in yield, a change in yield that's consistent with X% confidence interval T-day. Now, if we assume that changes in yield are normally distributed, and we calculate the standard deviation of yield changes and assume a mean daily change of 0, we can calculate, and again, assuming normality, we can calculate, say, a 95% confidence interval change over 5 years in yield. We'll call that Z of X times the standard deviation. Now that Z of X will depend on the confidence interval. Say for a 90% VaR, you can calculate a 1.28 standard deviation change, 95% VaR 1.65, and 99% 2.33. So this bond formula is really using this change in bond formula here, where we're going to substitute in the delta Y's a change in yield that's consistent with this confidence interval over this amount of time. So I can just show you the spreadsheet that does that. We won't redo it. So say you have a 30-year bond with those assumptions, it's our same bond. And we're looking for a 95% 5-day VaR. So we're looking at how much can we lose over the next 5 days with 95% confidence interval, or how much will we not lose? I'll first, if I have a data set, I can calculate, say, historical daily standard deviation of changes in yield. So this bond historically has had a 5 basis point daily standard deviation. We then calculate, if we're looking for a 95% confidence interval VaR, our statistic there is 1.64. So in other words, if an asset is normally distributed with a mean of 5 basis points, we'd be 95% confident we will not get a change larger, an adverse change larger than 1.645 standard deviations. So we then calculate our 5-day 1.65 standard deviation change. 5-day square root of 5 times the daily standard deviation. That'll give me the 5-day standard deviation times 1.65. So we would not expect to have a 17 basis point change or more go against us 95% of the time. So then we can calculate our VaR formula. Take initial value times minus duration times that 17 basis points plus 1/2 convexity times that 17 basis points squared. So our bond VaR, 95% 5-day VaR, is $19. So we're 95% confident we will not lose more than $19. And if I take that as a percentage of the initial bond value, we're 95% confident we will not lose 1.75% of our investment or more. But there is a 5% chance that we will lose this. Again, all this assumes that changes in yield are normally distributed, which is always troublesome, but it's an estimate to think about the risk. A couple smaller things to talk about. One is duration, the limitation of duration, and duration VaR in general is that it assumes that there's parallel shifts in the yield curve. So if I have a 30-year instrument, I'm assuming the 1 year through 30-year yields go plus or minus, say, 100 basis points. In practice, what we find is yield curves twist or move in non-parallel ways. So in this case, maybe the 1-year rate's down 5 basis points and the 30-year rate's down 50, so that would be a flattening of the yield curve. In this case, our duration is not capturing adequately the risk of the position. In finance, we use something called a key rate duration to measure the exposure to yield curve shifts or changes in slope. And the way you can think about a KRD, or key rate duration, is we can say take a 30-year bond, and instead of moving the yields up or minus 100 basis points and getting the value change, we can just see, well, what happens if we just shock the cash flows in the 30-year by plus or minus 100 basis points? What would be the change in price? And then do the 25-year and then the 20-year and 10-year. So a KRD would tell you your exposure to a particular sector of the yield curve shifting. And this is important. Say, for example, a 10-year zero coupon bond, may have a modified duration of, say, 9 years or 9.5 years. But since it has no coupons, the only cash flow is received in all the cash flows are received in year 10. So it's really only exposed to the 10-year changing. So you might see a 10-year KRD at 9.5 and all the other KRDs at 0. So we're not exposed to the short end of the yield curve changing. And last thing I was going to show you is you can use Excel's price and yield function. Excel's price and yield function do not, they ask for the yield, and they ask the maturity and discount rate for the bond, but they don't ask for the maturity. What they ask for is the maturity date, not years. So for example, if you had this information, you took a settlement of a bond on 1/1/2013 and matures 1/1/2043, so that's a 30-year bond. Now we can use my bond val, duration, and convexity functions to calculate duration, convexity, and bond value, but I can use Excel's built-in functions price, modified duration, M duration, and yield. And what you see is you get the same values, except this price gives you as a percentage, or assumes $100 par. So it would be selling for 110% of par. And these functions require you to put in the coupon rate, in this case the yield to maturity, the frequency of payment, the settlement and maturity date, and then redemption value is how much at maturity, what percentage of par is redeemed, and you will always put in 100%. And for the yield function, you're going to put in coupon rate, frequency, settlement, and maturity. And the current price of the bond, assuming $100 par. So that's using Excel's price and yield and M duration functions. Generally, I will always use Excel's duration, price, and yield functions, only because the functions that we've talked about so far, that we've built or used, assume the bond is on its coupon payment date. So it doesn't handle very well the fact that you might try to value the bond or calculate duration in between coupon payment dates, where modified duration or price or Excel's built-in functions will work on those dates. So in this topic, we valued bonds and computed yield to maturity. We computed the sensitivity of bonds with respect to changes in interest rate and saw that there's an inverse relationship. We used duration as a measure of the price sensitivity of the bond, specifically modified duration. And then we used convexity to adjust for the fact that the duration is a linear estimate, and we know that the actual price-yield relationship has to be nonlinear. We computed the VaR of a bond using duration and convexity, and we understand the duration and convexity of mortgages and use some of Excel's built-in functions.